Okay, here we go. It is November 16th here in San Antonio. It's 1:35 p.m. And I'm Tim Quast. Thank you for joining the Edge demo and discussion. I don't know we don't demo it really, but we sure talk about how to use it practically. That's certainly the aim. And the two rules are: please mute yourself while we're having this discussion, and then secondly, ask questions. Don't be shy. This is, we're a candid group here. There is no question that is dumb at all. Don't be reserved. Just ask whatever you want to ask, and we'll do our best to answer it. Brian Wilson, market strategist, who does a really fine job writing the market desk notes, which I appreciate. So thank you for doing that, Brian. Whatever he does well. He's going to take part one. I'll take part two. We'll try to do this in roughly, we aim for about 35 minutes ish. So we're respectful of your time and your day. And I will let Brian take it from here. He's got several points to cover. I will go through. I've got four things here that I hope will be helpful. So we'll divide and conquer. Brian.
Sounds good. Thank you, Tim. Hello, everyone. Great to see the veterans. And I think we have some newcomers here today as well. So thrilled that you can be on the call today. I have three points to cover. And I'm going to start off with the context of the market. If you're familiar with market structure dynamics, we talk about BCD. So broad market sentiment being the B, context being the C, and then the last one being divergence. So I just want to take a second to talk about context because we're in the middle of options expirations and just give you a couple of hints around expirations itself, what we've seen over time in terms of let's call it possible windows where strategies and tactics might change. What I want to show you is how to get to the calendar itself. So you can go to the main site and go to resources and then just pull up the expirations calendar. We have the one for 2024 already there. And what you will see when you pull it up, and we'll look at November, just as an example of what's taking place here. So we are obviously right here in the middle of expirations. You can see it right through here, the gray box. So not only do you want to be aware of possible strategic or tactical changes during expirations itself, you also have to be aware of a couple of other days as well. The first day is going to be Monday the 20th. That's when the focus will shift from the November expiration series to the December series. And then on Tuesday, the 21st, it's what we call Counterparty Tuesday. I don't think you'll see that in the financial press yet. Maybe it'll make it there someday. But Counterparty Tuesday, think of the big banks and brokers. We've just come through expirations. The focus has shifted to the new series. What do they have to do to balance their books? So we can see, additional volatility coming through there. We basically hit the clear the Wednesday after expirations. So if we see tactical or strategic changes, often it will occur perhaps the latter part of expirations or when we hit the clear next Wednesday. So just wanted to speak just for a moment in terms of context. You can think about it in terms of where we're at right now. Where are we? And I might be stealing part of Tim's thunder, but you think about where we're at from a strategic standpoint. We've had an incredible rally coming into expirations itself. We can see that we're starting to flatline from a sentiment perspective. That's the green here. What happens afterwards? A little bit to be determined. We talked in the note this morning that tech is just starting to show some convergence. We'll see if that continues or not. But, first point here is just to always be aware of the context of the market, that there's strategies that have been in play coming into expirations now. We don't know for sure, but those strategies might change afterwards. So just be forewarned. The second point I wanted to cover with you guys, and Henry and I last week were talking about what we call some of our aha moments in terms of, learning about market structure and how the markets work. I'll pull this back to a year-to-date kind of a look. And my point is the second point is that market cycles tend to be rather short. They tend to be rather predictable, moving around the options expiration cycle to a certain degree, moving around month-end, month-to-month transitions. But look at what's happening here. Let's say if you had come back to June of this year and you missed an opportunity, right? Or in your mind, you thought you missed it. Sentiment just ripped higher. It came through the red line. Well, guess what is going to happen? It's going to go back down, right? These cycles work in the rhythms of the market. Now, they're not always going to perhaps go all the way back down. You can see what happened here. It went back down to around neutral. You had a little bit of a buying opportunity once again, and then the markets, moved back higher. So some opportunities are better than others. Here's an opportunity where we had a long downstretch, got below the green line, which is for those new to market structure, you can think of that as oversold conditions in the market. Had an opportunity to buy at that point. But look at these cycles in the market. They're rather short and you get lots of opportunities. If you miss one and you trade long, you're going to get another opportunity, fairly soon, usually within a month or so. If you trade short, very similar. You'll usually have additional opportunities, within a month or so. Some are going to be better than others, but just recognize that these opportunities in the market are rather predictable. They tend to be short in nature. And recently they've become a little bit violent. You've seen the violent moves to the upside here over the course of the last couple of weeks. And recognize that some of these cycles, not only are they predictable, but they're predicated on what's happening from a behavioral perspective. We covered this last week, but it's good for a review. As we came into the latter part of October, the entire market was under pressure until we came to the very end of the month. We came to the end of the month. Guess what? We got one of those behaviors that jumped in as buyers. It was passive investors. Look at what was happening in the market. We had extreme pressure. That meant that passive investors were underweight relative to their models. They start buying equities. We get into a new month, new money trade. Boom, the market takes off. At the same time, I've been calling it a pain trade. Look at short volumes moving lower at the same time. So you get an extreme short covering rally that was accompanied by passive investors being underweight. That was exacerbated by a new month, new money trade. And you can see how these rallies kind of develop in the market. But it started off with passive investors and what they need to do in the market itself. Well, guess what's going to probably happen now? Look at this move higher.
Let me just interrupt you really quickly,
Yeah.
Brian, because I see, Steve, you got your hand up. So I don't want you to lose your train of thought there if you've got an observation. Sorry about that, Brian.
I do.
No, you're fine.
Yeah.
My question is in relation to the email that I sent you, Tim.
Yeah.
Just because I'm trying to grasp exactly what we're looking at here, because if we're looking at SPY,
right,
we're looking at only a sixth of the market,
right?
When we're looking at that, but when we're looking at our movement of our broad market sentiment, are we only looking at SPY or are we looking at the whole market?
Right. Yeah. So, well, it's a great observation. So for everybody else's benefit, Steve sent a note and said, hey, you know, are you looking at the Russell 2000, which, as I think how you phrased it, Steve, was for the first time in my lifetime, it's diverging from the other major benchmarks in a very material way. And, you know, what does that mean? And what's causing that? And Brian Wilson, don't lose your train of thought. You know, how we think about this, Steve, and you're right. I'll tell you, one of the things we look at internally, and particularly for the business that serves public companies, because they want to know this too, is that why are, I'm just gonna, Bill, I'm just gonna mute you. Sorry about that. You know, here a lot of these public companies are not performing like the benchmark at all. You know, you have the apparent, the S&P 500 is up, whatever it is, 18% this year, and yet a great deal of the market isn't up. And you know, I hate to do this, Brian, but I'm going to just very quickly to answer that question, because I want to share with you what our thinking is around this, Steve. So we track, if I may, and then I'll hand it back to you, Brian.
Sure.
I'm going to share a couple of slides, because we look at a lot of data. You know, we're a data analytics firm at root. That's really the genesis of everything we do. And here's to your point, I think, Steve. This is data from Wilshire Associates, which you might think of as, you know, they're the folks behind the Wilshire 5000 index, a very complete market index. Well, there are only 3,500 companies in the Wilshire 5000 index. You might think, well, shouldn't there be 5,000? Well, there used to be over 7,000 in that index. But this is the concentration that has occurred in the market. If you just think about the dark blue part of the graph, that is the 1,000 largest. Now, you know, they can't say the Russell 1000. They just say the top 1,000, but it's roughly the same thing. If you were to rank companies by market cap, the 1,000 largest are they're at any given point. So, you know, 93 to 95 to 7% of the market. So that's where all the money is. And look at from 2000 to 2022, I think this is 2022 data. Look what the trend line has been for those large caps. And look at what has happened to the Russell 2000. In effect, the amount of money in the Russell 2000 has been cut in half. And I'd say it wasn't the financial crisis that did it. It was regulation national market system, which pushed all the prices toward the midpoint, forced the exchanges to share data and customers and prices. And that fostered an explosion for index funds, because if you're going to track the average, now the market works best for averages. And so money flooded into index funds because they outperformed. I think that's a large part of it. There's been an enormous concentration of money in the largest stocks. If you really look at the indexes, the Wilshire large cap index has less than 500 components. The mid cap index has less than 300. Those 800 stocks are over 90% of market cap. The S&P 500 is 87% of market cap, and that's what you see. What happens is you end up with a haves and have-nots market, where the money from BlackRock, Vanguard, State Street need big liquid stocks. Those big, you know, the Magnificent Seven, we call them. They trade $100 billion of stock a day. Well, you got to have that. And I think that is what has happened, and it's bifurcating the market and leaving all of these stocks out. Now, a lot of the microcaps are not NMS stocks, National Market System stocks. They're not listed on the NYSE or the NASDAQ. They might be over the counter. But that, you know, there's 3,000 stocks there that don't have much market cap. And you can get moves in those, but this is why we focus on liquid stocks, because look at the trend. We know that more money is per capita going into large cap stocks. And here's part of the reason. This is the last thing I'll show you. This is also data from Wilshire. And Wilshire there's the number of components in the Wilshire 5000 over the last 4 decades. From 1980 to to 1998, that trend was up and we hit a peak of about 7,500 companies. And ever since then, the number of public companies in the market has fallen at the same time that the amount of money chasing them has increased and become more index driven, exchange traded fund driven, asset allocation driven, and all that money wants low volatility, liquid, large stocks. And that to me is what's creating this separation between the Russell 2000 and the large caps. So that's my answer, Steve. I'll hand it back to you, Brian.
So can I ask one more quick question then?
Please do. Yeah.
So if we're following this and we're looking, we should be concerned on the stocks that we're looking at buying by whether they're in the S&P 500.
Yeah.
Because that's what this whole thing is based on, is the S&P 500, correct?
It really is.
So the stocks that we go, if we're scanning for stocks and we see a stock that's looking like it just hit 10 and, everything you're looking for,
right?
You want to go check and see if that's in the S&P 500 so that to get a feel for what your broad market is for those stocks. If there is information about it.
Right. Yes.
Am I correct in what I'm saying?
Yes, you are correct. And the reason we use statistical mechanisms is because it's something that we do, is that we have read hundreds and hundreds of prospectuses, because we've tried to say, okay, are the indexes and exchange traded funds doing what they say? And what we have found consistently, and I've had these discussions with the BlackRock team that creates ETFs. I've had the discussions with the SEC, the regulators, and they will say, that must be substantially similar. So something that may not actually be in the S&P 500, but has all the characteristics of something in the S&P 500 can behave very similarly. So what we do to address that is to say, for instance, in the momentum portfolio that we create, we want very liquid stocks that have the characteristics of something that is very likely to be part of the S&P 500, but have greater volatility, therefore benefiting from the flow of money, but outperforming it. That's what we try to do statistically. Now, it doesn't work perfectly, but it works pretty well using the Hicks rule. Right? Go find those kind of things that have sharply divergent supply demand, 10 falling supply, but it's got the characteristics of an S&P 500 component, and you will benefit. That is absolutely our thinking. Yeah.
Okay.
Yep.
I didn't mean to take up so much time, but it's something that was a realization that this isn't really the whole stock market, that this is really the S&P 500 that we're looking at only, even though we have access to the entire market or close to it, 3,000 out of the 3,500.
Right. That's 99.5% of all market cap, believe it or not. Whatever that number is right now, $47 trillion of US market cap. You're absolutely right. What we're trying to do is to take advantage of the general trends in the market, which are toward concentration and passive asset allocation, but find the things that have the very best characteristics out of that group. Yeah. Yeah, you can't go apply it broadly, which I know is one of the things you've said, Steve. There'd be nice to have a score that will tell you whether these things are going to do what they're supposed to do. And I've got as I said, I've got two teams working on it. I just asked for an update on that. They're making progress. They're using some AI actually to study that data set, and we'll see what we can come up with. Yeah.
All righty. Well,
okay,
thank
Brian,
you.
Sorry
to dominate and take your time away from your normal thing here.
It's a very good point, because it is a fundamental lesson about using market structure edge. We're not just hunting for everything and applying technical factors to everything. We want to know, how does the market work, and what does the money do? What is the money doing, and how can we use those things to our advantage to make sure that the probability of producing returns is as high as possible? Yeah. Okay. So I appreciate that. Brian, back to you. Sorry. Take all the time you need. I can do what I have to cover in a very short period.
No, you're perfectly fine. Great question, Steve. Very, very applicable for, any of us that are looking at stocks and trying to determine, which ones, should we possibly buy. So I spent enough time talking about the market cycles, talking about, the fact that they're rather short. I did an exercise yesterday afternoon, just because I like data and I like running through the numbers. So I wanted to, and I'll take this back a little bit farther, take this back to a 3-year look. And I wanted to kind of address the question, what happens when you go above the red line? How long does it take when you go above the red line for you to return back to the red line again? What do the averages, tend to be for the market at large? And I did not cover this period through here because that was,
Hey, Brian,
of course,
you might want to share. Go ahead and share your screen again. I took it away from you. Apologies.
Oh, okay. I think it was being shared, but I'll try again.
Maybe you are. No.
You
Now
were sharing, Brian. Yeah,
now
you're
I
sharing.
got you. Now I got you. Yeah.
Got
Okay,
it.
maybe
Got it
was
there.
me.
Perfect.
Okay.
So what I did with the exercise is I ignored this stretch through here. Of course, it was an easy money stretch from the Fed, and you can see what the market was doing. It's hard to measure anything in that type of period. What I did for this exercise, I took it from beginning of 2022 going forward, so approximately a 2-year time span. And what I've found, as I have time, maybe a couple weeks from now when we do this exercise, maybe I'll do it for the green line as well. But what I found is there was 14 periods where we were above that red line. We had 5 periods red, and I'll show you the spreadsheet just to show you what I was doing here, just to give you an example. So for instance, on 1/3/22, sentiment went above 6. It came back below 6 on 1/13 for 9 trading days. What was the performance during that time? Negative 2.8%. And what I ended up seeing here is when the market was under pressure, going above the red line, didn't really help the market at all. So it was really, or didn't help performance at all. It was really relative to what the market was doing at that particular time. You can see there was one really bad stretch there in June. And let me show you what this looked like from a broad market perspective. So this is what was happening in the beginning part of 2022, just extreme pressure. And I'll share with you what happened as well with a couple of those periods where we had gains. This stretch right here was about a 10% gain for the broad market. This stretch right here was also about a 10% gain for the broad market. Take us back to the spreadsheet here. And what you end up seeing is those bursts in the market. Red line to red line, you had better performance for a couple of those. Now, this was it's a 2-year study. Take it for what it is, with the market being lower during 2022, for the most part being higher so far in 2023. This was the best performance that I saw. Red line to red line was 3.7%. And I'll just kind of take you through, what we saw over time, 3.4, 3.1. As we come into this year, which has been more of a bullish year, you can see for the most part that performance is less than 2%. So in other words, once you get above that red line, think of the whole market as getting stretched, and it becomes just more difficult to continue to post gains. And as we come through this year, you can see as we're coming into the summer, we had one stretch that was down just a little bit and 1.4%. For the whole exercise 2-year period, we were down negative 40 basis points. Average trading days, red line to red line, was about 11 days. So, what's your great, Brian? I'm glad you dove into the data. What's the takeaway here? Well, those periods where the market are stretched are generally tend to be pretty short. That's roughly a 2-week time frame. This is a 2-year study, but you can see that the market was not posting gains over that red line. There were time periods, yes, it was. And if you were setting up a trading strategy, I was thinking through this myself. Let's say you were selling I have not done this, so just full disclosure. But if you were selling perhaps like a call contract on the SPY, safe to say you could do a 1 month contract, because these are only 11 days on average. The greatest number that I saw was 24. And if you went like 5% above, you're well within the realms of where we've been during the last couple of years. So just trying to share with you what it actually looks like in the data itself. As we got those violent bursts in the market, that's when we tended to get more of the gains, above the red line. This market right through here, kind of steady, 1-2% gains. In other words, we tend to lose our momentum, when we get above the red line in kind of a, let's call it, normal market. So hopefully that's helpful. I'll do a similar exercise like I mentioned with the green line itself, but overall summary for a 2-year stretch, once again, down 40 basis points, and red line to red line about 11 trading days. And hopefully that was not too confusing, but just wanted to share what that actually looks like, from a big picture perspective. And it looks like you're muted, Tim, if you want to.
Yep. Yeah, James, you've got a question or observation.
Hi, Brian. So I know, Brian, that you haven't back channeled all the data, but would you then propose it's a swing trade? It's been a swing trade environment for the 2 years more than a day trade environment over the 2-year period, or you couldn't say from the data so far?
Oh, yeah, no, it's a good question. Yep. It's a good question, James. I don't know if I can make a distinct observation in regards to that.
Right.
Yeah.
What I would say, James, is when it comes back to a thesis to me that's just important from a risk management standpoint, that the data can, while there can be periods where you have gains. If you took the central tendency, the market does not offer any reliable additional gains when broad sentiment is above the red line. That's, I think, our thesis, that if you expect to produce a momentum return, the probability diminishes significantly once broad sentiment is above that red line. That to me is it. The best that you could get out of I think those 9 periods was 3.4%. And when demand is rising and supply is falling, you might get that every day trading AMD. That's the point. If you want to trade AMD, the period to do that is while the market is moving from 4 to 6. That's really it. That's where you're going to make your 20% trading AMD. Then you should turn cautious. I just think that that's a great way to preserve your capital.
Thank you.
Yep. Okay, I guess that means it's my turn. So I will shift. I'll pick and choose here. I will do one thing. I want to talk about the practical mechanics here. You veterans may already have your approach. If you're new and you say, okay, well, I can, the data are compelling. You can look at the supply demand balance. And Barry, do you want me to? I'll let you make your. Go ahead. I'll stop and let you.
Yes, I just have one quick question. When you look at the data historically and you see that broad market sentiment is over the red, do you see that when you've got members in the momentum portfolio like we have today, I think we have like 10 or 12, do you see that it's typically more the smaller cap companies, not the large cap companies?
It's a very good observation. That's exactly what I've seen too, right? We specifically in that portfolio exclude small caps, but that means there could be mid caps, and that basically we're trying to keep it in the Russell 1000. But that, as you noted, that means you could have stocks with 5-10 billion of market cap that are really on the lower end, and you're absolutely right. That's what shows up, like SMCI. For instance.
So when I woke up today, you look at the momentum portfolio that everybody sees. Okay, great. But when you look at the inverse, one of the number one stocks in there, Tesla.
There you go. It flips, doesn't it?
It flips.
Yes. Yes. I think you're absolutely right about that. It's what sometimes people will call the dash for trash, that the waning edge of the momentum trade means you get to the smaller drags. And already then Tesla has peaked and has begun to signal that now you should go short those. Like Brian wrote in the market desk note today. I shorted the market today. I don't, I'm going to not give myself much risk. I put a pretty narrow parameter around that, but I can look at the data and go, well, I don't want to be long anymore. It doesn't mean that the market can't rise, but I think that's a very astute observation. When you see that the average market cap in momentum has shrunk, you're probably at the very tail end of the momentum trade. Yeah. And for those who are new, here's what I mean. What Barry's talking about, that's the Norton rule. The Hicks rule is the long trade. The Norton rule is the short trade. Falling demand that has peaked and begun to decline, supply that's beginning to rise. That's the time to short. Just look at it. You can see it here. I run a mega caps portfolio. All I want to know is what are the stocks in this data set that have 100 billion in market cap or more. That's all it's looking for. Okay, and it fluctuates. When the market fell, it dropped all the way to 90. So, isn't that interesting? And now it's got 100. And that alone tells you, well, probably we added 10%. And sure enough, we did. But look what's happening. Demand has turned over, and look at the supply trend. Well, what is the probability that the mega caps continue to rise? Well, it's a number approaching 0. And there's your, you can see that. Then go look at big tech. Big tech looks almost identical because big tech is mega caps. It's the concentrated version, and look at that. It's beginning to tip over. Demand has waned. It doesn't mean it can't recover. It can, the down cycle could be short. I don't know what it's going to do, but the beautiful thing is the supply demand balance will tell us in short-term increments what it's going to do, and that's what matters to us as traders. We want to let's make 1% take it, 1% take it. You keep doing that, you get rich. That's really the point here. So you look at that and say, well, I can tell that the supply demand equation is no longer supporting an aggressive momentum trade. To the mechanics, when do you do something? How do you know? Well, when demand is rising and supply is falling, and say the futures are up, pick the S&P 500, the futures are up 25 points. What is the probability that it continues to rise? Well, when demand is ramping and it hasn't gotten to 6 yet, and supply is falling, there's a very high probability. I may just buy it right off, even though it may fluctuate a little bit. I'll put in a stop that's a reasonable amount down. Is it 30 basis points? Maybe. Right? So I'm not going to take a big chance, but I know that the probability is that there are more inflows than outflows, so that the likelihood that I'm stopped out is very small because I can see the supply demand equation. But then once it goes up, most of its daily volatility, just think 2%, that the average stock moves about 2%, is a little bit more than that. So if the S&P 500 goes up 1.8%, you're not going to get more than that. If it goes up 1%, I like that, and you could leverage it. I'm not saying you should do this. Always qualify. We share our experience. We're not giving you advice, but I will use SPXL, and which produces the 3 times levered return. So then I can get maybe 1.5 to 2 or 3% out of those momentum moves, and I'll do it right off the bat. When we get later in this stage of a momentum market, sometimes the market will do this and then retreat. Why? High frequency traders are doing that. They're seeing all the tick data, all the supply and demand data, just like we are, but in fractions of seconds. And so they tend to lower the market and then lift the market, then lower it. Well, those things are going to play out. So if the market deteriorates, but the supply demand equation is still in your favor, then you can buy that dip, because in all probability during the day, it will retrace that. And I know that there are technical, retracement themes that you could use. I don't know those things. I use supply and demand. But now I know, even though, what's happening now? Demand has peaked. Supply is still falling, but now you're out there. The momentum is fading. And so Am I taking a little bit of a chance shorting the market? Sure, but options context. See that little square in there? Options are expiring. If the market is going to change direction as the supply demand equation indicates, it's probable that it happens here because it happened here and it happened here. And you could go all the way back through the data set, and there are exceptions, of course. But most of the time, that's where the changes occur. So I'm willing to take a small chance now to buy SPXU. And if I get stopped out, that's fine. I'll come back. I might be a little early, but that's how I think about it practically, mechanically. And I just execute the trades. Okay, that's all I've got. Thoughts, comments, questions? Enough market structure for one day? That's a long used phrase internally. I was seeing here in San Antonio, and I was in Austin just a couple of days ago, and Dell is a longtime customer of ours. And I stopped and saw the Dell team, and I can see them. 45 minutes of talking market structure and the reasons why things are occurring, and you begin to see eyes that look like this, right? I'll just say that's enough market structure for today, and that's where we are. So we will not do this next week because it's Thanksgiving. Calendly and I realize we have a demo scheduled for next Thursday, but I'll have to move that to the following Thursday, which I'll do. So if you're marking Thanksgiving, enjoy it. We certainly will. The last thing I need to do is eat more, but I probably will anyway. And we'll look forward to seeing you the week after that. So thank you very much, everybody.